be talking about inherited IRA and setting beneficiaries and how important it is to make sure that you're always updating and making sure that you know who is your beneficiary for what account that you have, so you know that your beneficiaries are set up in your passing. So today we'll be talking about the building a strong financial future with your inheritance roadmap. So disclaimer, as always, we are not tax advisors, we're not CPAs, advisors, we're not professionals, we do not give legal advice for any of our accounts or anything that has to do with them, but we can give you the overview about everything else. So what is a self-directed retirement plan? A self-directed IRA is just a marketing term. IRA is an IRA no matter where it is. And what are the benefits of self-direction? So the benefits, of course, as always, are truly diversifying your portfolio, the tax savings, and being able to invest in what you know best. So beneficiaries. The beneficiary is a person or party chosen to inherit the assets or proceeds from the arrangement in your passing. Beneficiaries can be individuals such as family members, friends, or any other person specified in the arrangement. Organizations such as charities, nonprofit organizations, or educational institutions can benefit from your IRA. Entities such as business entities or a state can also benefit from the IRA. So non-spouse beneficiaries. So you have two different options when it comes to inheriting an IRA. You can take the lump sum distribution or set up an inherited IRA using the 10-year rule. We'll get a little bit into that in just a little bit. Inherited IRAs, like we mentioned, choose the lump sum or take the required minimum distributions. And the rules vary, so we always recommend meeting with a CPA or financial advisor to review your accounts. Eligible designated beneficiaries. So if an IRA beneficiary is an eligible designated beneficiary, then the beneficiary is the owner's surviving spouse, minor child, disabled individual, a chronically ill individual, and any other individual who is not more than 10 years younger than the IRA owner. So let's get into a little bit about who these people are and who qualifies for what type of person that they are. Owner's minor child. So a child who has not reached the age of 18, they are not permitted to take an inheritance from the IRA. So what will happen with these minor children is that the IRA will stay in that IRA until they become 18 years old, which at that point the 10-year rule would apply. So let's go into a little bit about what the 10-year rule is a little bit after we discuss this. So when the child reaches the age of 18, the 10-year rule goes into effect, and the child has until December 31st of the 10th following year of their legal birthday to withdraw all of the funds. Chronically ill individuals, they have been certified and licensed by a healthcare practitioner as being unable to perform without substantial assistance from other individuals at least 2 activities of daily living for at least 90 days due to a loss of functional capacity, having a level of disability similar as determined under regulations prescribed by the Secretary in consultation with the Secretary of Health and Human Services. The level of disability described in clause or requiring substantial supervision to protect individuals from threats to health or safety due to the cognitive impairment. Disabled individuals. Disabled individuals are unable to engage in substantial gainful activity because of any medically determinable physical or mental impairment, which can be expected to result in death or to be the long continued and indefinite duration. A disabled individual who inherits a retirement account will use their life expectancy to calculate required minimum distributions. So let's get into what the 10-year rule is. So when you do inherit the IRA, you have 10 years to take the required minimum distributions to empty this account. So basically, they would take the entirety of all IRA accounts that you are inheriting, divide that number by 10 years, Each year, you will take out the required minimum distribution. You will meet with a CPA or financial advisor to determine the amount that you are required to take each year. But on the 10th year of December 31st, you will have to have everything out of this account and all taxes paid. If there's any taxes requirements in it, of course, meet with the CPA or financial advisor to determine what taxes or RMDs that you will be responsible for. So lump sum distribution, that is your second option. That would be taking everything out as a lump sum distribution of the inherited account, where you withdraw the entire account, pay the fees associated, of course, meet with your financial advisor to determine how much you would be responsible for in taxes. Beneficiaries must include any distributions they receive in their gross income filings for the taxes. So any money that you take out of the IRA will be added to your earned income for the year, and you will be taxed on that at whatever tax bracket that would put you in, if there are tax requirements. So spousal beneficiaries. They have more flexibility than any other beneficiaries because they have more options when it comes to taking over the inherited IRA. So their options are either to roll over into an inherited IRA, into a personal IRA. There's tax advantages of that, and they can re-register the IRA into their own name. So they're able to take the IRA, take off the name of the person who has passed, and they put their name on that IRA and take it over as if it was their own. And this is for spouses. And then steps to set up your beneficiary. So fill out the necessary beneficiary form and necessary information: the name, birth date, social security number, address if it's needed, and percentage of how you would want them to receive their benefits. Review and update regularly. Consider contingent beneficiaries and submit the form. So primary versus contingent beneficiaries. Primary beneficiaries are the individuals that are receiving the inheritance upon your passing. Contingents are if the contingents will inherit your assets in the event that there are no surviving primary beneficiaries. So who would you want this to go to if you and your primary passed away? So there's two different ways when it comes to making or setting your beneficiaries inside of your IRA account. There's per stirpes and there's per capita. So per stirpes, distribution based on a family line or branch. Each branch receives equal shares of the assets. So per stirpes is also known as by representation. It is a method of distributing assets based on the family line or branch. In this method, each branch of the family receives an equal share of the assets regardless of the number of individuals in each branch. If primary beneficiary predeceases the account holder, then their share is then divided equally among their own children, the next generation. The share is not divided equally among all beneficiaries, but rather based on the number of children in each branch. For example, let's say an account holder has 3 children, A, B, and C. Child A has 2 children, Child B has 3 children, and Child C has no children. If Child A predeceases the account owner, their share of the assets would be divided equally between their 2 children, while children B and C would still receive their own share. Per capita. Per capita is also known as by head. It's a method of distributing assets equally among all living beneficiaries, regardless of their family line or branch. If a primary beneficiary predeceases the account holder, the deceased beneficiary's share is not distributed to their own children or descendants, but instead the remaining living beneficiaries require an equal share of the assets. For example, let's say an account holder has 3 children, A, B, and C. If Child A predeceases the account owner, their share of the assets would be divided equally between children B and C, with each receiving an additional share. It is important to note that the specific method used to distribute assets may be determined by the account holder's estate planning documents, such as a will or a trust, or by the laws of the jurisdiction governing of the distribution. It's inadvisable, of course, to consult with an attorney, a CPA, or a financial advisor. So here's an example of something that has happened with somebody that didn't keep updated with their beneficiaries, which is why at the beginning we mentioned how important that it is to set beneficiaries, because life changes, divorces happen, marriages happen. You want to make sure that your primary and contingent beneficiaries are always set up the way that they need to be. And here's an example why. So my daughter left her trust and left all of her assets, mainly in an IRA, to me, her mother, to take care of her kids in case something were to happen to her. Sadly, her daughter left the world before her, meaning that the daughter has passed away, and the mom is now taking care of her children. Money is tight, and most of the money was in her IRA. But when she called the brokerage, they told the mother that she was not the beneficiary of the IRA. It turns out the ex-husband was the beneficiary of the IRA. It was not an amicable divorce, and the grandma had a question: doesn't her trust override the beneficiary form? The answer: a trust or will does not override the designated beneficiary of the IRA. So even if you have an estate planner and you have your will and trust set up, it doesn't override the beneficiary form of the IRA. So make sure that you have the beneficiaries of the IRA set up the way that you want them and update them each year, or in any case that may have changed the beneficiaries. So inherited IRAs for non-US residents. Clients will need to apply for an ITIN, and this is an individual taxpayer identification number. It's a processing number used by the Internal Revenue Service, and they issue items to individuals who are required to have a U.S. taxpayer identification number, but do not have a social security number. So once they have applied for the ITIN, they will have to file a W-8 BEN form. The W-8 BEN is an Internal Revenue Service mandated form to correct non-resident alien taxpayer information for individuals for reporting purposes and to document their status of the reporting purpose. Once this has been completed, then they are eligible to open the inherited IRA, where we will show your established account receiving your shares of the IRA. And at that point, if you're looking to do a distribution or in the 10-year rule, either one would apply. It's up to you. Of course, meet with your tax advisor or CPA. Please be on the lookout for our class on setting up trusts and will. In the next couple of weeks, we will be having an attorney come on and speak more in depth about beneficiaries, setting up a will, setting up a trust, and estate planning. Is there any questions?
We have a couple from online. The first one was, can I name more than one beneficiary for my IRA? And if so, how do I allocate the funds among them?
Yeah, so you can have as many beneficiaries as you'd like. If they are set as primary, the total share percentage divided between them would have to equal 100%. But you can set as many as you'd like, either primary or contingent. As we mentioned, primary would be who it would go to upon your passing, and then contingent would be who it would go to upon their passing after your passing.
Great. The other one was, how do I change my IRA beneficiary, and are there any restrictions on who I can name?
How do you change your IRA beneficiary?
Yes.
You would just fill out a beneficiary change form and provide the birthday, social, and address of the new beneficiaries and how you want it set up, and we can easily change it in the system for you.
And then the last online question was, what happens if I don't name a beneficiary for my IRA, or if my beneficiary predeceases me?
So what was the first question?
What happens if I don't have a beneficiary for my IRA?
If you don't have a beneficiary for your IRA, it will go into probate. And at that point, they will determine where your funds will go, whether it be to the estate or to any children or family members that you may have.
And then the second half of that question was, or if my beneficiary predeceases me.
If you're, again, it would go to probate and it would go through the same system that it would go to for them to determine who would end up with the funds.
Great, that's everything from online.
All right, well, thank you so much for joining us today. We're so happy to have you. Please check out our socials and go ahead and scan the QR code. We look forward to seeing you.